this off you.
Yeah, yeah, for sure. Do you want to grab that first, actually? Or there's another one here.
Silence, please all rise.
Good morning, please sit down.
Application 1 of 2019 on the Commission's own motion, 2019 State Wage Order pursuant to Section 50, Capital A of the Industrial Relations Act, and Application 34 of 2018 on the Commission's own motion, application for the creation of an equal remuneration principle.
Now, Mr Entrin, you appear for the Minister.
I do, Chief Commissioner.
Thank you. And Mr Farrell with Mr Walsh for CCI.
That's correct, Chief Commissioner.
Thank you. And Dr Diamond for Unions WA. Thank
correct.
you. And Mr Toomey for WACOS.
That's correct.
Thank you. Right. Now, we have received outlines of submission from the Minister, from CCI, from Unions WA and from WACOS. We have received submissions in reply from the Minister and from Unions WA. We had been informed that the Community Legal Centres Incorporated wanted to be heard, but they have this morning advised us that having read WACOS's submission, their concerns will be before the Commission. So, Mr Entrin.
Thank you, Chief Commissioner. If it pleases the Commission and Court session, we'll begin with the usual presentation by our expert witness from the Department of Treasury on the economic outlook for Western Australia, and this will be followed by an opportunity for questions. I will then briefly summarise the Minister's position as outlined in the submission and the submission in reply, filed by the Minister on the 14th and 17th of May respectively, and I'll also address the equal remuneration principle as part of that. If it pleases the Commission and Court session, I will now call Mr Christmas to the witness box.
Thank you. Mr Christmas.
Mr Christmas, would you like to affirm or make an oath?
Affirm, thank you.
Please state your full name and address.
David Bryan Christmas at 28 Barrack Street, Perth.
Do you sincerely declare and affirm that the evidence that you shall give to this commission shall be the truth, the whole truth, and nothing but the truth?
I do.
Good morning, Mr Christmas. Please sit down.
Thank you.
Now, I take it we're in your hands. You're going to, as you usually do, provide us with a presentation and a PowerPoint
Yes. Yep.
presentation. And I understand that you have copies of your PowerPoint presentation for us. Is that correct?
Stand.
Yeah, I can. Certainly, I've got some copies that I can provide.
I think you may have assumed, Mr Entrin, that having forwarded them to the Commission that we would have provided copies for ourselves, and I'm afraid we haven't.
I was thinking perhaps that was the case, but that's okay. I have some spares.
Thank you.
So, no problem.
Yes, thank you.
Thank you. Okay, today the presentation will be largely based on the state budget papers that were released on the 9th of May 2019. And for comparative purposes, I'll make some references to the Commonwealth budget, which was early this year and was tabled on the 2nd of April 2019, and some references to last presentation, because, which will be, the last state budget, which was the basis for the last presentation. Overall economic conditions have been softer in 2018-19 than anticipated in the 2018-19 budget. The International Monetary Fund has downgraded its forecast for global economic growth, and the national and state economies have been impacted by tighter access to credit and declining house prices. This has coincided with the completion of construction work on the last of the major LNG plants. What that means is those are the factors which mean that growth has been softer. Reflecting this, the domestic conditions and have been reflected in the labour market, so things have been softer there as well. Overall, the state's economy is expected to expand by 2% in 2018-19. That follows 1.9% growth in 2017-18, and the first contraction in the state economy that's on record, the ABS series, of minus 1.8 in 2016-17. Growth expected to pick up to 3.5% in 2019-20, supported by a lift in investment, which in turn should support stronger conditions in the labour market and an increase in population and higher household spending. So I'll just go through that summary in a bit of detail now. The global context, the IMF has revised down its forecast for global growth from 3.6% in 2018 to 3.3% in 2019, with growth bouncing back to 3.6% in 2020. It's also forecasting that the advanced economies will grow more slowly. So advanced economies growth is expected to slow from 2.2% last year, that is 2018, to 1.8% in 2019. The IMF forecast that growth in China will progressively soften from 6.6% in 2018 to 6.3% in 2019. Growth in West Australia's major trading partners is expected to slow from 4.6% to 4.4% in 2019. Activity in some sectors of the Chinese economy moderated over the course of 2018. For example, trade-exposed manufacturers have been adversely impacted by weaker growth in key markets, namely Europe and East Asia, and increased trade barriers from the US. Growth policies to improve the stability of the financial sector by reducing reliance on less regulated mechanisms appear to have had a short-term negative impact on Chinese growth. However, activity in the commodity-intensive sector of China, such as construction and energy, appear to have been robust as a result of relaxing macro policy settings, which appear to have been pursued more aggressively in the last 6 months. That includes tax cuts and significant infrastructure announcements. So the Chinese government has been conscious it wants to maintain growth. It's 50% of our export market, so that's why I've sort of focused on China. But even though the Chinese economy generally, there's a bit of slowing going on, the government's efforts to maintain growth are in the sectors that are positive for WA, and that's supported commodity prices. So just going to commodity prices, they've been higher, they've been picking up through the year. Now, obviously that's been supported by iron ore price, which accounts for a lot of our exports. The iron ore price has been supported by a couple of things. There was a problem with one of the tailings dams in Brazil in January, which has resulted in people being scared about the amount of supply in the market, and that was exacerbated for WA with the cyclone Veronica, which actually shut down exports for a week or so, roughly a week. Now that's a smallish shutdown, but it just shows how the market's reacting to that sort of news. So as of today, in the last day or two, the iron ore price in US dollar terms has been around 100, just above 100 US dollars per tonne, which is something we wouldn't have been expecting in our media review even. So that high price has been very good for us. Oil prices have been pretty solid. Monthly exchange rate, that's one that actually we've had the exchange rate falling over the last year. So the Australian dollar is weakened for a number of reasons. Partly Australian economic data is a bit weaker than anticipated. The ongoing US-China trade dispute, a stronger US dollar and a significant increase in the odds that the RBA will reduce its overnight cash rate. And I'll just get on, I'll get to the cash rate shortly. In terms of the national economy, so it's not just our outlook that's changed, it's the national outlook has changed. So between last year's budget and this year's Commonwealth budget, they've revised down growth, the growth estimate for 2018-19 by 0.75%, so from 3% to 2.25%. That's largely a revision due to the household consumption being weaker than we thought and dwelling investment as well. And those patterns are also relevant for the West Australian economy. So the softness there has been attributed to a couple of different things. One of those is tighter access to credit and also house prices in the eastern states declining. We've had some house price softness here, but the size of the falls in the major markets over there are the issue. Turning to the interest rate, so over the past year, the Reserve Bank's left the cash rate unchanged. There's been slight increases in the standard variable home loan rate, and that's just because banks are finding their borrowing costs are a little bit higher. So there's been out-of-cycle rate increases. You've probably been watching the news, would have seen that the Reserve Bank Governor has, and it's something very unusual, but come out and basically said that at the next board meeting in 2 weeks' time, they'll be considering whether or not to put the rate down rather than up. So people are treating that as a signal that it's likely to go down. And indeed, the market's expecting at least one rate cut and possibly two. So...
Yes, I understood that the signalling was that there would be two this year, most likely. Yeah.
And that seems to reveal some concern by the RBA about the underlying strength of the economy.
Yes, it does. I think nationally things have softened as that sort of those budget. I haven't got a comparison there to last year, but as I said, with real GDP growth being forecast down by that much. It's the state of the housing market is obviously a concern with the house prices falling as much as they have been. It's not only the RBA, I should mention as well. APRA yesterday came out and said APRA basically regulates the banks and their lending practices, and it's flagged that it may change some of the regulations to make it a little easier to borrow without, they're still going to have regulations that are designed to protect the stability of the system, but they may feel they went a little bit far,
over the top in some
yeah,
areas.
or they've achieved what they want to is probably a better way to put it, and now they can maybe normalise it a bit. So that sort of one of the reasons the Commonwealth still thinks that growth's going to be picking up is obviously interest rates have been low. They're still accommodative, but now they look like they're going to be more accommodative, plus tax cuts that have been flagged in the budget and even before, actually. So if those things come on, that would provide a fillip to income, well, after-tax income, as well as more disposable income, because you're not spending on paying off your mortgage. So just turning to the WA economy, and this is one I've put up. We don't forecast by industry, so I should note that. Our forecasts are by the expenditure base, and that's what I'll take you through now. But I have been asked a number of questions in the past on agriculture. So agriculture sector, actually in 2016-17 it had a record harvest of about 17.7 million tonnes. Last year in 17-18 that fell to 14.6. 14.6 is sounds a lot lower, and it is lower, but it's not actually a particularly low result. It's just coming off that very strong peak. But this year, ABARES, which is the Australian Bureau of Agriculture and Resource Economics, actually expects the harvest to be close to 17.7 tonnes again. In fact, they're slightly higher than 17.7, but slightly lower than the peak. So agriculture sector seems to be doing quite well. Obviously, the iron ore price means the next section of our economy is doing extremely well as well, and that's flowing through to a number of the other industries. GSP growth, we're expecting, I mentioned before, 2% growth this year. So gross state product being domestic economy plus net exports. 2% following 1.9% the year before, and we're expecting that to pick up to 3.5%. We've really had 5 years of below historical average growth, and that is all due to the domestic economy having been contracting for most of that period. And it really just reflects that business investment came off a peak of $80 billion in 2012-13, and it's now close to 30. Well, we estimate within Treasury, and that's the budget numbers, that it will reach a trough, a cyclical trough of 34.1 billion in 18-19. So we're expecting this year to be the bottom. And then we're expecting that to pick up, and I'll go through that in a sec. So, this just shows the breakdown of growth. One thing to know, a lot of the investment I'm about to talk to you about is replacement projects. They're actually just to maintain production. There will be some increase in production, but largely the projects are to maintain production. So what you can see there, net exports are actually making a lot smaller contribution to growth than they have in the past. And that's because all those LNG and iron ore projects from the last boom are basically operating at capacity or will be in the next year or two. So the LNG ones will take a year or two to get to capacity, even from now. But once that's done, the actual incremental increases are going to be quite modest. So the contribution from exports is going to be smaller, and you can see that that's why we're actually forecasting that GSP growth won't return to that 4.3% per annum in the future, or at least the foreseeable future. So this investment story is what is the driver of growth in activity in WA. And as I've mentioned, it's gone from about 80 billion in 2012-13 to 34.1 billion. We're actually expecting that to increase next year by 6%. and in the next 2 years after that, it'll be we think 7% and 6% again. So we're really expecting a gradual pickup with investment, but a substantial one. And the first one we've sort of seen for. Actually, you can see in the last, just before that forecast line, there was a very slight increase in 17, 18, and that's just the timing of some work on the LNG projects. It's not that there was a substantial lift in activity other than that. So apart from that one time, it's business investment's been declining for about 6 or 7 years. So next year, the first pickup, and a reasonable pickup. So we've got, as part of that South Flank, Kadaidri, Olawana and Iron Bridge, those are the 4 big projects that are going on. They're mostly replacement, but Iron Bridge, which is a fairly big project, is a new one that will add to production. All those have a value of about $13 billion. There's also a lot of lithium projects, and those that have received approval already are valued at least $3.3 billion, according to our estimates. And there's more than that in the pipeline. They just haven't had their final investment approval. Over the next 12 to 18 months, there's a number of big LNG plants that are also being considered. So that's why we've got a fairly positive business investment outlook. This is our consumption outlook, and this is where you can see. Well, it's not our outlook; it's actually actuals. What you can see here is, about 5 years of very low or sub 1.8% growth, or 1.8% per annum growth. Increases in household consumption, and those have been dominated by non-discretionary items. So what that tells us is that consumers are being quite cautious with their spending. They're spending on what they have to, like increasing their spending on food and things like that, but they're not spending on items where they've got some sort of discretion. Well, a little bit, but not as much as you'd expect if things were going as they have in the past. So one of the reasons is, and I think I've mentioned in the past, we don't have a household savings ratio in WA that is comparable to national, but since my last appearance, we do have one. So this is it. This is our net household saving ratio. What it does show is we're, after the GFC, the household saving ratio actually increased quite substantially nationally and WA, although WA went a bit further with its savings. And while there has been some come off from those high levels, WA in the last couple of years, WA is still well above. And in fact, last year, while it fell, it only fell modestly. So one of the reasons for that, obviously the kick up from the GFC would have been people seeing that the economy was subject to international conditions, and there would have been a response, sort of a cautious response to the uncertainty that would have created. But this also for WA, why has it sort of gone further and why has it stayed higher? We don't necessarily have all the answers, but to us, we would say that part of that is wealth, house prices. House prices actually in WA have been varying between about 485,000 and 550,000 for the last, since December 2012. So they haven't, and they peaked, they're at the high end of that at the end of 2014, and that they're at the low end of that right now. So they've gone from about 550 towards 550,000 in December 2012 to about 485,000 on the REWA website for I think that's March quarter. So, when people see their housing wealth going down, that's obviously a concern for them. And they spend less. The realisation that the mining boom was unique and that investment boom, so, that investment booms sort of ended in 2012-13, people would have known that the projects they were on would have been ending. So that's probably another element. And modest wage increases and employment growth. In fact, employment growth until more recently has been weakish and indeed has fallen in a couple of years over the period since the GFC.
Are you saying, Mr. Christmas, that people have cash at bank that is not spending it?
Well, they may be using it to pay off their mortgage.
Right, let's just call it cash they could access if they wanted to, but they're not, for the purposes of household consumption.
For consumption, they're earning, they are earning more than they're spending, which would leave you with a cash element there.
So is confidence the key here to the spending of that money?
One thing, confidence has been weak until it sort of troughed in about 15, 16. And it's actually, through 17, 18, it's gradually been picking up, but from very low levels. And it's really more in the last sort of year, in 2018, it's got to be positive. And at the end of 2018 and early 2019, and the CCI produces one of these, and they can sort of affirm it or whatever, it has come off. It sort of reached a peak late 2018 or early 2019, and the latest data is a little bit off that. There's a couple of different sources, but that's generally the pattern, right? So that recent softening may just reflect that towards the end of last year, we've been in this period of a domestic decline. However, employment had grown through to the middle of last year, and then it's sort of really fell around the turn of the year. So I'll get to it, but you'll see in November employment was flat. In December it actually fell 1%, and then in January it was flat. So that employment effect would probably have had an impact on consumption as well.
And I suppose the $64,000 question is if there are further interest rate reductions and or combined tax rate reductions, whether that will translate into further net savings or consumption.
Yes.
In the hands of consumers, if I can put it that way.
Yes.
Households.
The fact that sentiment's turned positive, I think, is a change. To date, we haven't seen that flow through to consumption, but the way the outlook for the economy and the fact that we're expecting investment to lift, and that's almost we've already got projects in the bag. Not all those are actually happening right now, and they'll be happening in 2019-20. Most of those will actually get to their peak construction level. So as that happens, you're going to actually have that feel-good factor from employment and the demand for workers from those projects. So the projects are a little bit staged, but at some point they're actually all going to be happening at once. And I should correct myself. There may be a preliminary work happening on some already, but it's really next year where they're all happening in earnest. So I should just correct that. So they may actually all have little bits going on, but it really is next year where it sort of starts to. And I think the other thing is there's been a dearth, or there was a period there where you didn't hear of new projects. And to be honest, that's where I sort of monitor at the back of my mind, and it's gone from sort of a drought to this. It's gradually starting to hear about projects much more often. The high commodity prices obviously will be a help, and a weaker dollar, it's under 70 cents today. If that persists, will actually assist with competitiveness as well. So all those things bode well for a bit of a lift. And as I suppose as people get that confidence and certainty, and as employment growth lifts, you get that greater job security. That's when we think people that saving rate should start coming down. There's no reason why that saving rate should be. No apparent reason. Obviously, consumers are saying there is, but why? As our economy and our domestic economy starts picking back to the national, why it should be so much higher? Unless there's something I'm not seeing.
Well, is it that intangible of confidence?
Well, it is, but what I'm saying is as we become, as our growth picks up to national growth in the domestic economy, confidence should sort of turn in line. You just expect, confidence would turn in line with that. It's just we've had 7 years of falling demand. Well, not quite. We actually had 1%, I think, growth in SFD last year, but we're expecting that was a blip, and we're expecting this year to be the last year of, several years, a sustained period of declines in domestic demand. So household consumption, we actually think it will pick up. We think this year, you can see we've revised down a lot since last year's budget, and we think it's going to be about 7.75% this year. But that we are expecting to pick up next year, and that's because we are of that effect of those investment projects. Things like, and not only private sector, there's work on the Metronet and a number of other road projects picks up. There's a number of things that are going to support labour demand. And clearly that pickup will be more gradual than we thought at last year's budget, but nevertheless we do expect it to get towards, but not quite get to the historical average. In terms of dwelling investment, that has been weak, and it's a different pattern from last year's budget. We're actually having dwelling investment falling in 2018-19 when we thought it might actually increase, and we are actually expect it to fall further next year, but by a fairly small amount next year, and then pick up from 2021 onwards. The reasons for that and why we're fairly confident that's going to happen is the rental vacancy rate has fallen from 7.3% to 2.5% in the March quarter this year, so 7.3% in the June quarter 2017. Now, the labour rental market's sort of a broader indicator of the total market, so when that's in balance, it's roughly the whole market's in balance. We're even seeing very modest rises in the reported median rent. So in the March quarter this year, both for units and homes, rent was $10 higher than last year. So that's not 10%, it's a lot less than that. But it's just saying that market is close to balance, right? And so when that's close to balance, that's a good starting point. We haven't actually been adding a lot of stock to supply. And so the stock of housing, the supply of housing has been very subdued in the last couple of years. In calendar 2018, there was 16,100 new commencements. That's about half what they were at their peak in the year to March quarter 2015, when they were at 32,800. Now, that 32,800 was unsustainable, so it's come off a lot, but 16,000 is a very low number. So since there's been a couple of years of fairly low additions to stock, and we're not expecting, we're expecting a couple of years in the 16 to to 18,000. So this last year, and I think next year we'll have something. We are expecting the commencements to lift, but again, it's still historically low.
And would
So-
part of that be changes in population due to the end of the mining and construction boom?
That's part of why demand would have tapered and why commencements have come off. Yep, certainly. One of the reasons we think so, you've had this. The market's close to balance now. We're having very small additions to supply, and the other factor is that actually we think population growth will past the trough and gradually expecting population growth to lift. And I'll get to that in a second. So if you add all those three components up, plus a little bit of government spending, which I haven't focused on, but these are the main private sector drivers of growth. And to be honest, main drivers of growth generally. You've got this sort of pattern of state final demand, which is the domestic economy. So we had a little blip last year of it going up, and I think, now for this year we're expecting it to decline for the very last time in this sort of current subdued cycle. That said,
So
we're
I
not
think we
expecting it to.
I think we thought that last year was the trough. We'd ended the trough and were starting to build, but it appears that's been a bit delayed.
Last year, what we had for our forecasts, yes, we had we had a minus 0.25% decline, so flattish. Yeah, so we still expected this year to be the trough, but not to have declined by much. Yeah, basically stable. And now, that's been revised to -1, and that's largely a bit of timing. But we, again, even in this domestic economy, we're not expecting growth. We're expecting to get close to the long run average, but not quite reach it, even in the out years. So what has been saving us a lot is this the export sector, and that's been growing quite substantially. We think the rate, as I mentioned before, of growth in that will taper off. So at the moment we've got growth of around 4% in 2018-19 and 2019-20, 4.25% in 2018-19 for merchandise exports, and 4% next year. But we think that's going to slow to 1.75% in the later couple of years of the forecast period. So population, we are expecting that does appear to have troughed. So the trough, in annual average terms, population growth troughed at 0.6% in the March quarter 2017. And it's been increasing, albeit very gradually, to the latest data suggests it's 0.8% in September quarter 2018. And that is the latest data. It just shows that it's 6 months out of date, which sort of can be a bit frustrating, and we're looking at methods of trying to improve we won't improve the timeliness of the published data, but better ways to track it in the interim period. That said, net migration is expected to lift, and for a fair amount of that period, for another year or two, we're expecting natural increase to be the main driver. But certainly by 2021-22, we'd be expecting that migration will be the driver again.
Is that related to the project work?
It's related to two things. The project work, which is going to boost activity generally, so it's related to investment, but it's also related to the fact that we think those other elements are going to pick up as well. So dwellings, we've just talked about, and consumption once consumers get confident enough to stop to spend rather than save, which we think is going to happen closer than shortly because of that feel-good factor from the projects. So what we have found is net internal migration, not interstate migration, is very responsive to whether WA is growing, the domestic economy is growing faster here than nationally. And so it is, at the moment, obviously, national domestic economy is growing faster, so we've still got an outflow to other states, but we are expecting that to reverse as soon, or at least, we are expecting that to reverse so that we actually have migration from other states by the end of the period, even before the end of the period. And net overseas migration, we usually account for, so prior to the mining boom, we accounted for around 13.5% of national migration, and it was a surprisingly stable share. And so we think that we'll go back to something like that share towards the end, just after the end of this budget period. So when you take those two things account, we're expecting migration to increase from around 1,500 people in 2017-18 to 29,100 persons in 2022-23.
Tweets featuring quackers are helping too, I take it, Mr. Christmas?
Well, I suppose they don't hurt. They certainly.
Sorry, what were the figures you just provided from?
So net migration, and that includes both interstate and overseas migration. We're forecasting to lift from around 1,500 people in 2017-18 to 29,100 people in 22-23. So natural increase is expected to be the major contributor until 2021, where I think it's fairly close to balance in that year. Total migration's already turned from being around 2,300 persons migrating from the state in the year to March quarter 2017 to 3,300 people coming to the state over the year to the September quarter 2018. So, we are actually seeing it in the data. It's just not at the rates that we're expecting it to get to. So the labour market, over the last year, we've had employment growth dominated by, it's been, full-time, if you take it to the very last observation. So annual average growth in employment was 1% in April 2019. Of that, 1.5 percentage points was contributed by full-time, and there was a 6 percentage point detraction from part-time. But as you can see, that's only just sort of changed in that April 2019 observation. Up till then, there was contributions. Well, the full-time contribution has been strengthening, and the part-time has been coming off. So we look at annual average at much more than your monthly rate, and that's because the monthly rates are so volatile. We've actually put a short paper on our website on that, because the media love the latest monthly stuff, but actually you need to abstract from monthly volatility to understand the underlying trends. Internet vacancies they've levelled off, but they are still higher than last year. So over the year to March 2019, there were around 16,000 vacancies on average, compared to 14,663 vacancies in the year to March 2018. So they have lifted, and the strongest increases have been in mining and related occupations such as structural steel, welding, metal fitters and machinists, and mining engineers. And the SEEK data, which is separate data, also suggests there's increase in new job ads that are strongest in the mining operation roles. This shows I did mention that In November, there was flat employment, December -1%, and flat in January. And what that did was remarkably, you can see the impact on that on what we call quarterly year ended, which is the latest 3 months at any point in time on the same 3 months a year earlier. While we look at that, is that actually in general shows you what's going to happen with annual average, even though we think annual average is better, and we think it's better because it's less volatile. You can see that the year ended is less volatile. Year ended can pick turning points a bit better, but you can actually see that that end of year, start of year effect really hit the year ended growth. We're still expecting employment growth though to reach be at 1%, which is roughly where it is right now in annual average terms by the end of this year, and then to increase to 1.75% next year, and gradually 2% for a couple of years, and right at the end there get close to its long-term historical average, in fact slightly above it. But the immediate profile is obviously 1% to 1.75. Where's it all happening? Well, this is the annual average change in people employed to February, and February mining and related. So in fact, in that manufacturing, it's primary and fabricated metal manufacturing, and something like metal processing, which isn't so can be fairly basic, but you talk about it as being manufacturing rather than mining. So those are areas of strength, plus some service sectors as well. The largest decline being in the construction industry. Now, we think that we can't really disaggregate construction into residential and non-residential, but obviously as we're expecting residential construction to start lifting, we'd expect that to start, the rate of decline to start sort of dissipate, and in fact actually have some increases, at least in the residential component. The unemployment rate has stayed up for more than higher than, and for longer than we expected. The unemployment rate, again, it's very volatile, so 6.8% in January this year and 5.9% in February, which is again just an example of why we look at an annual average. So in annual average terms to April, it was 6.2%, slightly higher than a year ago, 5.9%. We've now had an unemployment rate a little bit above the national for a reasonable, probably around a year. I haven't got the actual number here, but just if you observe from the slide, maybe a little bit longer. But that's New South Wales and Victoria, much lower rates. So at the moment, New South Wales is 4.5% and Victoria is 4.7%. But Queensland, like us, Queensland's got one of 6.1% and Tasmania is 6.2%. So there are other states out there with similar rates. We're expecting the profile, as employment growth picks up along the lines we were talking about, that the unemployment rate will gradually decline over the period to be 5.25% by the end of the period. So just graduated steps down from 6.25 this year.
Is that an annual average growth?
Oh, it's not growth, sorry, our rate. That's a good point.
Yeah, okay.
It's a rate. Yep.
So we're really pretty much around the historical average rate.
We are, yes. Yep. This is the part rate, and actually part rate has been elevated relative to the national. Well, we're almost always elevated relative to the national, but It's also been picked off a recent low. Now we think that's in part due to people coming into the labour market, given there's been some employment growth over the last year and a bit, and so there's been an attraction element of that, people coming in, and that would have, because the part rate's gone up, that would have also held the unemployment rate up a bit higher as well.
One of the things that I picked up in the Outlook document is the still quite stubbornly high underemployment rate. That is the
Yes.
labour, the amount of spare capacity, which
Yes.
seems to be in the labour market.
Yep.
And that seems to be tracking still at a fairly high level, from what I can gather.
It is. I've got a chart on that and wages in a minute, so
sorry.
I'll revisit that. I did miss a chart, not because I meant to, but the unemployment rate for the youth has been higher as well. And so, in the year to April 2019, that was 14.2% for 15 to 24-year-olds. Although you can see that's just looks like it's just starting to come off as well. It's sort of consistent with subdued growth for in that sort of age demographic, but it's also, it does appear that at least until recently, and I looked at the data for the last 12 months, and there is actually employment growth in that cohort at the moment, but until about, a year ago, you'd have had that cohort actually declining in annual average terms in terms of employment. And it did seem for a while at least that employers might have been favouring skilled workers relative to... But the data I saw this morning does show it's returned to growth of about 0.6% for that cohort, which is still below the average, but at least it's growing. So going to the wages, and this is where I'll come also to that underutilisation. Wages growth has been, as you can see, very flat. We do use WPI as our preferred measure, and that's because it measures wage changes for a fixed quantity and quality of labour and abstracts from compositional changes, such as hours worked or movements between industries. So over the year, in the March quarter, in annual average terms, wage growth was 1.5%. You can see that's marginally higher than the recent trough, but it's still very modest by historical standards. Growth was 0.3% in the March quarter, and you can see from the chart it's been around 0.3% except for a couple of blips for several years now. In year-ended terms, it's slightly higher, so in the March quarter it was 1.6% growth. Private sector growth is 1.6% in annual average terms and 1.7% in year-ended terms, so the private sector growth is picking up, albeit sort of from, again, it's still subdued, but it is picking up. By industry, the strongest rate of annual average growth was in accommodation and food services, 2.2% in annual average terms to March. But that said, in the March quarter, that industry itself only grew by 0.2%. So, yeah, it's just sort of where there's a positive, there's also something saying, well, don't get too excited just yet. Where there were positives in the March quarter, though, were transport, postal and warehousing, which grew by 0.8%, and professional, scientific and technical services grew by 0.7%. And that professional, scientific and technical services is related, is an industry that's generally related to mining, so mining engineers and architects and this sort of thing. So that sort of growth in those two industries in the March quarter is boding well for a little bit of a pickup in activity, provided that that continues. So our 2019-20 budget estimates are for growth of 1.75% in this year, increasing to 2.25% next year, and progressively increasing to 3.25% after that. That again reflects both the fact that we think the domestic economy is growing, and there's also likely to be some national wage growth is stronger than ours, and to the extent that there's agreements set nationally, but predominantly with employment conditions or conditions in the East Coast in mind, if they're higher than us, there may be some spillover to us as well in certain parts of our labour market. So the solid growth, and we don't, this is the chart I was referring to.
Sorry, can I just take you back to that issue of, excuse me, the wage price index? One would anticipate, I assume, that given the scope of the Western Australian industrial system and the people who are affected by the minimum wage decision, that the spillover from the east would have an effect on the wage price index in a larger measure from the corporate sector than in the private sector, small business sector where there's less bargaining. Would that be a fair assumption? Or
I think probably in the corporate sector, because they're more likely to be operating in multiple jurisdictions, and and so the smaller businesses, there'll be a lot more of those that are just operating in this state alone.
yes,
So where there's not, where though any arrangements that might happen for those businesses you'd expect would be determined more by local conditions than national.
oh, I see.
That's sort of where
Yes.
I'm going at.
Right, thank you.
With this slide, so this is the, underutilisation is the underemployment rate plus the unemployment rate. So this adds the two together, and what we've charted, and it's a very close relationship, as you can see, is wages, the wage growth in annual average terms, and we've got here quarterly average underutilisation rate. So the quarterly average underutilisation rate has come off a trough of 16, or a peak rather, because that scale's inversed on the right-hand side. So it's come off a peak of 16.6% to 15.2% in the March quarter 2017 to 15.2% in the March quarter 2019. That said, it's still high. We don't forecast underemployment or the underutilisation rate, but implicit in our assumptions that wages growth is going to strengthen, that is that our view that as the demand for labour picks up, underutilisation and underemployment will
Should
come off.
hopefully soak up some of that excess capacity.
Yep.
Yes.
And are you saying causation between a drop in underutilisation and an increase in wages, or correlation? What you said?
Well,
interesting,
certainly
they track each other.
correlation. The causation's probably the drivers, underlying drivers, so they're both being caused by things like investment picking up, which means that employers want more people. Obviously, if there's, and to date, there's not been big pockets of skill shortages. But if you talk to recruitment agents, there are pockets of it, mainly and again in mining. But as generally demand for labour lifts, you'd expect that people are going to want labour.
Greater competition on wages and salaries.
Yeah,
of
that's
course.
right. So giving it a lift.
But whilst you're not forecasting, insofar as the dark blue line is heading north, you're saying you would expect the light blue line to follow it.
Ah, yes.
Okay.
Yep. So just the last item before, just the risks. Consumer price index was actually fell, I think it was 0.1% in the March quarter. So that part of that was due to decline in automotive fuel, which has since we expect to reverse itself out in the June quarter. So, and also holiday travel and accommodation, both so fuel took 0.3 percentage points off, and holiday travel 0.2 percentage points, and those were offset by food and non-alcoholic beverages, slight increases in contributions from them, health and education. The annual increase was, so in annual terms, CPI increased by 1.2% in March, and the increases were more in alcohol and tobacco, 4.42 percentage points, transport 0.41 percentage points, health 0.25, and we'll leave it at utilities 0.23, recreation culture 0.22, and food and non-alcohol was 0.16. And those increases were partly offset by housing, and which has been a drag for several years. Lower rents detracted 0.3 percentage points, and new dwelling purchases detracted 1.16 percentage points. So that difference between one of the reasons inflation is different here than nationally is because, and we'll actually get to it, this slide shows it, just the different forecasts, is because housing's been such a drag on the inflation rate here. Now, as the rental market has turned to balance, we expect that drag to basically dissipate, and that's one of the reasons over time you can expect the two inflation rates to converge. Just going here, so we're expecting 1.25% increase in 2018-19, and increasing to 1.75% next year. And then by the end of the period, getting back to the Reserve Bank's mid-range. And as you can see, our Reserve Bank has been good at keeping the average right within the middle of its band, so that's why we would expect it to stay there. And this does make the point I was making earlier, and I don't think we need to go on, just that we will converge over time as the housing markets converge. Just risk to outlook, timing and extent of business investment. As I said, we're expecting we've got a large amount of investment in the bag in terms of it's already been approved. And there's other projects that we're aware of with varying degrees of probability of them going ahead. We need to make judgments, and we do that in line with, we consult Department of State Development, JETSI it's called nowadays, tourism and forgotten what the last one is, JETSI, but anyway, we consult that organisation, because actually often the project people need to talk to them to get approvals and things like that. So they've got a bit of an idea of what's likely to go ahead and what's not with any, so it's just we use them as a test rather. So I mentioned there's a couple of big projects that are due to be considered for FID this year, and in the next 12 to 18 months. And even if they go ahead, the timing can mean that our forecast can move this way or that way quite substantially. So they're always a risk, and there's a risk that our probabilities are wrong, and that can impact on growth. I think the general feel though at the moment is, and you see that because of the higher commodities, the lower Aussie dollar, and the fact that at least now costs are still quite low, that is all project positive. Population growth, if our forecasts aren't as strong, if actuals don't grow as fast as we're forecasting, obviously that'll impact on different sectors, including the household demand or household consumption. Household consumption is partly driven by population growth, and the housing market, could actually, after the announcements of the last 2 days and the prospect of negative gearing being taken away is no longer there, at least in the immediate future, following the election, then there's a number of factors that suggest that housing demand actually post-election or post-budget may be stronger than we anticipated. So there's some upside and downside risk there. Growth in China and advanced economies. Well, growth in China, while some of the sectors are growing, some are being supported by various stimulus measures, and in fact, we may actually see that those stimulus measures take growth above expectations. Global trade, well, that's always, with the main protagonist being someone who's fairly can make decisions fairly radically. One can never be quite certain how that's going to proceed, but and we actually thought that there was a while there that China and the US had basically held off escalating, and it's just more recently there's been a bit of escalation. I think the general view is, there's still probably a general view that's all about trying to get a negotiated outcome, and in fact the US seems to have made peace with Canada and Mexico, while there was a bit of tension there, and now it's come through that. So that would sort of suggest there's a bit of that sort of negotiation, strategic stuff going on. One can never be entirely sure, so there's always a bit of uncertainty there. So those are the sort of key risks to the outlook as we see it. Sorry, we had this last slide here is really just reiterating the points that I made at the start. Near-term activity has been impacted by slower, particularly that access to credit, which has happened nationally. It's not just us, everyone's been affected. And that's why we sort of revised down, even since mid-year review, we revised our outlook. That's sort of been exacerbated by the ending of work on the mega LNG projects. We always knew that was going to happen, but it's just the coincidence of those things happening at the same time. And that weakness in the domestic economy has flown through to the labour market. You can see that at that sort of end of last year, start of this year, and the fact that we've revised down our employment growth forecast to be 1%, just shows that there's been some weakness relative to what we thought this time last year, but obviously we are expecting conditions to improve in 2019, 20 and the out years.
Thank you. Now, Mr. Farrell, do you have any questions for Mr. Christmas?
No, thank you, Chief Commissioner. Nothing from us.
Thank you. Dr. Diamond.
Yes, thank you, Chief Commissioner. So if I'll crave your indulgence, I'll just find the page that I was wanting to refer to. So, Mr. Christmas, thank you for your presentation. I'm looking at page 14. This is the net household savings ratio. Mm-hmm. So this was you said this was a new bit of information. You hadn't been able to.
It's new in that the two are directly comparable. We did have an indicator of what the savings rate was in the past, But it wasn't directly comparable because that had what we call consumption of fixed assets added on, and so it would have been a slightly higher than that level.
Okay. And so when you're looking at this sort of figure, are you able to disaggregate its impact by sort of income levels, deciles or quartiles, or is it? Sort of
This is for
solely
it's based on aggregated data, and so we don't have this is aggregated data directly from the ABS. It's not something we've tried to break down by income level. I'm not sure we would even have the data if we wanted it.
No, it's certainly difficult to find this sort of stuff at the state level, but it would be fair to say, would it not, because this sort of data has been presented in the, for example, the WACOS submission, that when you're talking about households in the lowest sort of deciles, lowest percentiles of household income, this sort of figure doesn't necessarily reflect their saving behaviour.
So it's effectively this is an average, and so yes, different income groups could have different behaviours. Yes.
That's right. And we do know from the data that sort of lower income households tend to spend more.
Proportionally.
Yep. So actually, with that in mind, so just to pick up on a couple of things. So you mentioned that there's a situation where there's tighter access to credit happening from banks, but we're also flagging, based on the Reserve Bank Governor's speech yesterday, there seems to be a consensus, I guess we'll see, that we're looking at rate cuts, 1 and possibly 2. So to what extent do those two elements work at cross purposes? Sort of tighter lending.
Yes.
And
So I suppose why there's been tightening in lending is partly because of the Royal Commission into banking, and even before that, APRA was actually tightening its regulations for several years now. So including tightening, a number of investor loans and that sort of thing. So it's been going on, but we think probably last year with the Royal Commission on Banking actually sort of drawing this to the attention of everyone, and banks making sure that they are seen to be responsive and responsible. That's where we think the tightening has happened. We know that just anecdotally. What APRA yesterday also flagging is changing at least some of that tweaking of the regulations, so that right now they have a sort of you have to test your loans against a hurdle rate of about 7%. They're talking about making that whatever your mortgage rate is plus 2.5%, which at the moment I think on average is about 6.4%. So it's bringing that hurdle rate down a bit. So that what APRA's doing is actually not inconsistent with what the bank's doing. They both seem to be signalling, okay, the housing market things got a bit too tight. We're now more comfortable that banks have actually been implementing some of the things that we wanted them to. Obviously, they're feeling comfortable enough to say, okay, let's review those regulations, and can we within reason and still maintaining the integrity of the financial system and the stability, maybe loosen things off either in terms of the cash rate or in terms of some of that regulation. So the two happened to sort of happen yesterday, and so they coincided with each other. So I'm saying that would be a timing thing. Up till now, there's this definite credit access issue, and look, it's up to the banks how they want to actually proceed. Just because APRA says something in terms of loosening things, they may still want to be prudent. Different banks may behave slightly differently.
Right, but it would be the case that banks have been behaving differently on a number of occasions and through a number of cycles. from what the Reserve Bank necessarily sends out
Yep.
through the cash rate.
Yeah, although you would see from that earlier chart on interest rates, you know, the cash rate generally does impact, guide the direction of your
I'd got the idea, Mr. Christmas, sorry to interrupt Mr. Diamond, Dr. Diamond, that the Reserve Bank is sort of a bit pessimistic about what they could do now with monetary policy, and they were saying that if the economy's stuck in second gear, we really are looking for wages growth to do something about that. Am I misinterpreting some of the things I've read?
Certainly, the governor has indicated that he wants stronger wage growth. What I think he's saying is it's got to the point where other indicators are saying we should. There's scope to. Another reason why he didn't really want to, and the Reserve Bank's been a real reluctant, I suppose. They're only going to this reluctantly. Is a cash rate of 1.5% doesn't give you much reserve power, reserve policy power if things go real bad.
No, they're frustrated and they're saying we can't get wages growth, so we have to go to this even though we don't want to. That's as I interpret what the governor's been saying. Whether the link is as strong as that, but it's certainly saying we want consumption to be stronger, and it hasn't been. And part of that is he wants wages to be increased. So yes, and he's got to the point where he's also saying, well, actually, the overall economy hasn't gone as strongly as we want. Now that's partly because of consumption, partly because of dwellings as well, because dwellings over east is also being affected. So he's saying he's got to that point where he hasn't promised it, but it's basically flagged it. It's the governor, as close as the governor's ever got to this sort of thing, other than actually outright announcing it. So they're very concerned about total growth.
There's also an element there, if I recall, I read to the effect that this concern to increase wage rates and consumption was subject to productivity improvement or something of that nature. Have I misread that?
To be honest, what I've done is seen the headline and a tiny bit of news footage on television rather than seeing the whole comment that he's made. So
thank you.
I'd be talking beyond my
thank you.
knowledge.
So just one more question, if I may. So looking at the issue of the underemployment and underutilisation rate, which once again I'm going to have to crave your indulgence while I find exactly where the figure was. Oh, here we go, page 33. There we go. So the component of the underutilisation rate that represents the underemployment rate, insofar as that's kind of counts as spare capacity to be absorbed by the economy, you would expect that people who would be, the phrase goes, marginally attached to the labour market, as in people who are more likely to enter into lower skilled sort of service sector jobs, would be the people who would be most likely to be reabsorbed, if you like, if the or rather to get an increase in hours if the underemployment component was going to be going down.
So I don't actually have the sort of underemployment by industry data in front of me, and I don't actually even recall seeing it, which is, I may have seen it, but I don't recall seeing it. So I'm a little bit sort of constrained in how definitive I could be in that.
No, that's fair enough. One of the things that we've found is that, or one of the things that the Reserve Bank Governor, I should say, has identified with the lower rate of income growth is that as people, and I think the phrase is decided to adjust their spending plans, downwards, that's been impacted in the sort of very low retail trade data that we've been seeing most recently, both at the national and the state level.
Yeah, so if income is being more constrained, income's one of the key drivers of consumption. Now, there's different views and theories about how income growth goes through to consumption, whether that reduction in income is permanent or temporary and things like that. But, as a rule, you'd expect weaker income growth to flow through at some point unless it's perceived as temporary drop in income.
So the household consumption expenditure, which is, once again, I'm not going to this particular thing, but I'm going to the state budget, which they've got it as average annual growth to December 2018. It's about 1.1% in Western Australia, as opposed to 2.6% nationally. So if the household consumption expenditure was higher, we would be expecting more spending on discretionary items, at least somewhat, and we'd be expecting we'd be expecting retail trade the retail trade industry to be lifting to the extent that industry begins to recover.
If we had a higher expenditure, consumption or incomes, yes, you'd expect that to flow as a general principle to all consumption, provided that they haven't sort of delayed stuff on other items, but some of those items in the retail trade would be stuff they'd want to spend on. Yep.
Thank you very much, Mr. Christmas. Thank you, Commissioners.
Mr Toomey, do you have any questions?
Yeah, thank you, Chief Commissioner. Just a quick comment first. I think what Dr. Diamond was referring to in terms of savings was the graph that we have on page 41, which basically shows for the lowest quintile, their savings are actually negative. The majority of the savings are the highest, and we certainly expect those on the minimum wage to be in the bottom two quintiles. So their picture there would be a bit different. Sorry, I'll just grab hold of this.
I'm sorry, what page did you say?
Oh, sorry, page 41 of our submission.
Thank
so
you.
It kind of looks like that, and the light blue is the savings component.
Thank you.
Mr. Christmas, I was curious, particularly the comments around the Reserve Bank Governor's comments and the issues of wage growth and consumption. I was interested to what you would think the relationship between wage growth, WPI, and what actually happens around kind of the decisions around the state minimum wage should be. Would we be expecting where the government is projecting kind of forward growth to be happening in WPI, that the minimum wage would be following that? Should it be leading that? Is there any particular expectations around that relationship?
That's not for me to determine. That's for
Okay.
This whole wage case is about that. Not for me.
Can I perhaps ask, what is it that you see are the drivers for that projected growth in the wage price index? Because we know that we've had this extended period of wage stagnation. There's been this concern between the productivity gap and the gap on returns from businesses to wage growth. So why would we expect that relationship to reattach or be changing?
So the period of weak consumption growth is about 5 years, right? We know that from, that happens to really nicely coincides with the end of the business investment boom.
Yeah.
It coincides with the period where domestic economy has either been shrinking or in one case, increased by 1%, and that again is just a timing issue, right? That whole pattern has been driven by business investment, and we are saying investment will pick up We've got good reasons to think that. A variety of sources tell us that. So we're expecting domestic economy to start expanding. So it hasn't been expanding for that whole period. So it's worth bearing that in mind. So the driver of wages growth, as we see it, is going to be the pickup in domestic demand, which is primarily being driven by business investment, lifting for the first time in substantively in, I think, 7 years. It did actually, as I said, went up by 0.1% in 1 year. It was a tiny increase. That's what's driving our view that labour market conditions will tighten, competition for labour will pick up, and wages will reflect that.
Because, I mean, certainly when it went to your graph around the gross state product, what it kind of shows is going into the future that all the heavy lifting's been done by the domestic economy. We're expecting, you know, the forecast there around net exports is dropping, but certainly we've had an extended period where the domestic economy's been quite flat.
Yep.
And unless people have actually got the money to spend and the confidence to be spending it, that's clearly a challenge.
Yeah, so I think one of the reasons, I suppose what I was trying to say earlier is part of confidence was sort of weakest. I think it was in the 15-16 calendar. It was still weak in 17.
Yeah.
Even the start of 18, but it was starting to get above the sort of what you call long run level, I suppose, to a point where it's starting to tell you that, well, things are looking up relative to the long run, or at least a level which is no growth in, no positivity. So that's turned. What people haven't actually seen, because investment is still declining, is the domestic economy increasing. But as these projects progressively start being commenced and the work starts ramping up to peak levels, and they're all going at the same time, that's when you're going to see domestic demand lifting. So the whole that's why we think demand for labour will go up. We're quite clear that business investment's been falling for that entire period.
Right. I guess one of the reasons why I'm asking this is that when we looked at last year's projections, it was a similar story you were talking about, and then there was a blip or a delay.
Yeah.
Was that a blip, or you know?
Well,
because
yeah,
there was a difference there between last year's projections around the growth of employment and the domestic economy and what we've seen. It wasn't a big one, but it was certainly there. So you're kind of more confident now that that's settled out?
Well, we're confident. We're very confident business investment will fall for this year. We can see that in the data already, but we're very confident that it will pick up. That's why that's our central base scenario. We have those 4 projects in iron ore alone. They're not as big as the LNG projects, but they're not actually insubstantial, particularly when you add them all together.
Yeah.
So that's why we're confident that investment's going to pick up next year, as in starting in about a month's time.
Yeah.
So, that's being very pedantic about timing, but we are moving to that transition where it's bottomed and it's going to start lifting. So we're confident of that. That's what our budget numbers are based on, and it's consistent with the private new capital expectations survey ABS undertook. There's a variety of reasons why we think next year it's going to go up. So that blip we see is possibly a large capital item came in, possibly an LNG related item, which is significant enough to change. And again, that just shows that timing can impact on growth forecasts, enough to shift it from basically a small decline in an increase in domestic activity, but not a large increase.
Okay, thank you very much. Thank you, Commissioners. No further
Thank you.
questions.
If I may, are you not allowed an opportunity? Mr. Christmas, Mr. Toomey's first question pricked my interest. He asked, if we go to page 32 of the power, as I understood his question, where the budget forecasts an increase in the wage price index, as I understood the question, does it make assumptions about top-down things done by the Fair Work Commission and this commission? Or is it all based on a bottom-up sort of approach about where investment is heading? And
I suppose our wage price index is
whether you know, are there any assumptions about top-down stuff in there?
We haven't explicitly modelled what we think this or the Fair Wage Commission will be, the decision, okay, that you'll make. It's based on our view of the macroeconomy and how that might impact. What we do split out. So there's a number of ways we look at and develop these models. One is that sort of looking at the economy and what does that mean. So all the different elements of the macroeconomy and what does that mean for wages. The other way is also to look at private and public and build it up that way. But again, ultimately, a private sector forecast is based on the way we would do it is at a macro level, so informed by macro aggregates, not by building it from decisions.
Okay. So I think that's a no, is it not? That no assumptions are worked into it.
Not on
Fair Work's going to give at least 1%. Or
no,
nothing like
not
that.
on these sort. Neither are explicitly included.
What is the current state government debt?
If you
Do you know that?
I've got the budget paper here, and in 2018-19, net debt is expected to be 36.28 billion. Actually, at 30 June, that was based on they've made a recent accounting change. That was pre-accounting change, which brought in operating leases, and when you include operating leases, which is now the way we're going to do things, that shifted net debt from that figure, $36.281 billion to $39.106 billion.
39.106 billion.
Yes, so that's on page 4 of our budget paper number 3.
Okay.
So the change is largely a bookkeeping change.
It's bringing something that we still did as an operating lease, but a change in the way that's accounted for in the accounting rules.
Yes.
But it does as a result increase our published debt numbers.
What was actual revenue last year?
In terms of the only one where we've got actual revenue is a year old, 17-18.
Yep.
So that was $27.475 billion.
24.475 billion. Okay.
Yeah.
And what's projected revenue for 18-19?
It's estimated actually is 29.925 billion. I should just clarify as well, the revenue numbers I've given you are what we call general government revenue numbers.
Yes.
That's the sector that's not, it doesn't include your government trading enterprises and things like that. The net debt figure I gave you, and this is just the way the basically the key aggregates are published, is for the total public sector, which will include the GTE debts.
And does government get a cut from the trading corporations that you referred to?
The part of that general government revenue is revenue from government trading enterprises and from either dividends or tax equivalent payments.
Yeah, so it's brought in the regular way. It's just that little asterisk you gave us that it didn't include certain.
Yeah. So the revenue from GTEs will be coming in through as a contribution to general government revenue, but the whole of GTEs aren't part of the general government.
Oh, I understand what you're saying.
Yep.
That would artificially inflate revenue.
I mean, you can find those numbers published in the budget as well, and I can provide that if you want. But that's not the sort of standard way we just publish those numbers.
Thank you, Mr. Christmas.
Mr. Christmas, in the Minister's submission, he's set out Table 6 gross operating surplus and gross mixed income, the GOS plus GMI, which, as I understand it, or rather, as the submission says, is a measure that's used as a proxy for profitability data at a state level. What that demonstrates is that the mining industry has brought in the highest level of profitability, and given the amount of that profitability, it actually constitutes on its own a significant proportion of profitability within the state. I note that from there down, you have quite different rates and annual increases for the various industries.
Mm-hmm.
Given the significance, A, the significance of the mining industry, and B, the changes that are forecast in terms of projects and the like, is there any accepted theory to the effect that there is any automatic ratio or flow on of profitability to the other industries in the state?
Okay. The flow through of that profitability, so there'll be flow through to the extent that profitability encourages activity and investment, and that's one of the ways. And so as mining companies subcontract out work, and those workers go and buy stuff from retailers, so that'll help the retail industry, and then because it raises incomes of people working in the mining sector, that they'll spend it on new housing, so that'll help with construction. That's the sort of way it will work. But there's no sort of set ratio like that. The other thing to bear in mind is it depends whether the companies use the profitability to invest or what they do with their profits. So some of those may be distributed to people directly. What we do know for those, a relatively reasonable share of mining ownership is overseas, so profits will be repatriated to some extent overseas as well. So, but that's a decision each company is going to be making.
Yes.
I suppose what we would say is the thing that will drive activity across, sectors through that trickle down that I sort of started off with. That's not the proper word for it, but it's just through those interconnections between industries.
Yes.
Is our view that investment, so our view that companies will be doing that investment work. Now, whether that's from retained profits or they borrow or whatever, is the company's decision. But what I'm saying is that the two don't necessarily. You could choose not to invest even though you're really profitable, or you could say, well, what's behind this profit? We need to get into this a bit more, because that usually profit's telling you that there's a signal, that perhaps this activity is worth investing more in. So
yes, thank you.
Again, that's a company decision.
Thank you for that. Right. Now, Mr. Hendricken, is there anything you want to raise with Mr. Christmas before we...
Nothing further, Chief Commissioner.
Thank you, Mr. Christmas. Thank you. Your presentation is always very useful to us.
Thank you,
for attending.
thank you.
I'll mark the presentation from Mr. Christmas as Exhibit Minister 1. Now, Mr. Entrican.
Thank you, Chief Commissioner, and thank you to Mr. Christmas. The Minister extends his sincere appreciation for your time today. I'll now move on to the Minister's position. The Minister relies primarily on the written submissions already lodged with the Commission, but I'll take the opportunity to reiterate the basis of the Minister's position and to address some of the issues that have been raised by the other parties. The Minister recognises the importance of maintaining a strong and meaningful safety net for employees covered by the state industrial relations system. The annual review of minimum and award wages is a vital component of the labour relations framework, a key objective of which is to ensure West Australians have a fair system of wages and conditions of employment. The Minister encourages the Commission to apply a just and considered approach to minimum award wage adjustments to improve the real value of workers' wages and to contribute to growth throughout the economy. The state wage case plays an integral role in assisting the low paid to meet their everyday needs. By granting a meaningful increase to minimum and award wages, the Commission can help to foster improved living standards for employees, which is another key objective of the state wage case process. The Minister recognises the state economy continues to transition following the end of the mining-led investment boom, and that while overall conditions are improving, some sectors are still experiencing challenging conditions. The mining sector itself is rebounding strongly in Western Australia, as Mr. Christmas's presentation demonstrated, something that should generate business investment and jobs growth in the years ahead. However, as noted in the Minister's primary submission, growth in retail turnover has been subdued and some slack remains in the labour market. Nonetheless, Western Australia's economy continues to gradually improve, as evidenced by an uplift in gross state product, a forecast return to positive business investment growth, and a rebound in domestic economic conditions. In the year to March 2019, total employment has increased by 1.1% in annual average terms, and that's actually 1% in the year to April 2019. A reduction of growth from 2.3% in 2017-18, so it has come down. However, it's still well above the 0.9% fall which was recorded in 2016-17. A moderation in the rate of employment growth in 2018-19 was actually expected due to work on several large LNG projects being completed. The Minister submits that in taking all of these factors into account, it's appropriate that the state minimum wage and award rates of pay be increased by $19.20 per week in this year's state wage order. A flat dollar adjustment would ensure that the greatest benefit of this year's state wage order is again directed to the lowest paid. And in this regard, the Minister notes the Commission itself has implemented flat dollar adjustments in many previous state wage decisions. A $19.20 per week adjustment would increase the state minimum wage by approximately 2.6%, taking it to $746.10 per week for a 38-hour week. The Minister's proposed increase would amount to less than 2.6% for award rates of pay above the minimum. For instance, it would represent a 2.3% increase in the C10 wage rate in the Metal Trades Award and a 2.1% increase for a senior hairdresser under the Hairdressers Award. The Minister acknowledges that a flat dollar increase will create a minor flattening of some award relativities between classifications. However, any change would be minimal. The Minister submits that a real wage increase is appropriate, given that many lower paid workers are struggling to make ends meet and are not in a position to negotiate higher rates of pay with their employer. By granting a modest real wage increase, the Commission can also help to guard against a widening of income inequality, something that can have undesirable social and economic consequences for the community. The Minister notes the most recent seasonally adjusted estimate of average weekly ordinary time earnings in Western Australia, that is AWOT, is $1,757.10 per week, or approximately $91,700 per annum. At the same time, the state minimum wage is currently less than $38,000 per annum. And the C10 classification, the skilled tradesperson's classification, is a little over $43,000 per annum. As outlined in the Minister's primary submission, the most recent employee earnings and hours data from 2018 indicates that award-reliant employees in Western Australia have much lower average earnings than those employed on collective agreements and individual arrangements. Minimum and award wage employees are not highly paid, and the state minimum wage order therefore plays an important role in maintaining a fair safety net of wages and employment conditions. Many low-paid workers rely on the increases determined in the state wage case to meet changes in their everyday living costs. I'll now briefly address some of the issues raised by the other parties in their submissions. In its submission, the CCI advocates the state minimum wage and state award wages to be increased by not more than 1.4%. While the Minister appreciates the CCI as advocating for an increase to the minimum and award wages in this year's state wage case, the Minister respectfully submits that the quantum proposed by the CCI would not provide low-paid employees with a meaningful wage adjustment in the current environment. Although wages growth is currently modest, rates of pay are nonetheless rising, with the Department of Treasury projecting the West Australian Wage Price Index will increase by an annual average rate of 1.75% in 2018-19 and 2.25% in 19-20. An increase of 1.4% or less would effectively see the wages of minimum and award wage earners rise by less than the workforce as a whole, which would contribute to an increase in wage inequality.
You do understand, Mr. Inchican, that the CCI's submissions are mainly directed toward the capacity of business to pay.
Certainly, yeah.
Right.
Yes.
And that's not something you know a lot about, presumably.
Well, I mean, certainly I'll let the CCI speak more to the capacity, but yes, I appreciate that that's where their position would be coming from, certainly. By granting regular real wage increases over the last few years, the Commission has played a crucial role in helping to counter wage inequality in Western Australia, improving the prosperity of many low-paid workers. And indeed, the minimum wage bite has actually stopped falling in the last couple of years and has actually risen slightly in that regard. The Minister submits that an increase of $19.20 would provide a fair and sustainable increase in pay for minimum and award wage earners. The Minister notes that Unions WA recommends the Commission increase minimum and award wages by $43.61 per week, or 6%, whichever is the higher. As a 6% increase is equal to or greater than $43.61 in all cases, in practice, Unions WA is effectively advocating for an increase of 6% to the state minimum wage and to all award wages. The Minister shares the concern of Unions WA that living standards of the low paid be protected. And while the Minister supports a real wage increase that will materially benefit low paid workers, it's also important that any adjustment supports ongoing jobs growth and enhances labour market opportunities for all West Australians. The Minister encourages the Commission to award a fair and sustainable outcome in this year's state wage case and contends that the Minister's position of $19.20 would appropriately achieve that aim. As noted by Unions WA in its primary submission, there are sections of the workforce that are currently award-free in the state jurisdiction, including workers engaged in many occupations, which would be covered by awards in the national jurisdiction. In the national system, almost all employees below the professional or managerial level are covered by an award. However, in the state system, award coverage is less comprehensive. Employees who aren't covered by an award are significantly less likely to have access to entitlements such as penalty rates, overtime provisions, allowances and annual leave loading. So given the fragmented nature of award coverage in the state, it's also important that the state minimum wage be adjusted by a meaningful amount, as it affects a significant proportion of workers in the state jurisdiction. As with Unions WA, WACOS proposes a $43.61 per week increase in the state minimum wage, albeit it hasn't specifically proposed a particular quantum for award wages above that level. As the quantum proposed by WACOS is similar to Unions WA, the Minister's earlier comments in regards to the position of Unions WA would be relevant in regard to the WACOS submission as well, in relation to the quantum. The Minister acknowledges the detailed information provided in the 2018 Cost of Living Report produced by WACOS. The report provides a comprehensive suite of information reflecting the financial situation of different low-income household types in Western Australia. And the Minister notes the information presented by WACOS about the negative impacts precarious employment can have on workers. And the Minister shares the concerns of WACOS about recent growth of insecure forms of work, including some jobs lacking many basic workplace protections. The Minister also notes the support of WACOS for the draft equal remuneration principle developed in response to application 34 of 2018. And the Minister welcomes the support of WACOS for this important initiative. I'll now briefly address the state wage principles.
Before you do, there's just one issue that I'd welcome your comment on. In respect of the issue that I raised with Mr. Christmas about the GOS and GMI measures of profitability.
Yes.
And just having a look at that, if I can find it, here we are. It would seem to me that if you take you take a look at the mining industry profitability in total, as compared with the total of all industries, it makes up around 45 to 47% of the total dollars in profitability in Western Australia. That's what appears
Correct,
to be.
yes.
If you take it out, the profitability, if you say that it's an outlier because it's quite considerably more than the rest of the industries separately, and of course, as I said, makes up about 47% in total. If you take it out as that outlier, it would seem that profitability is actually negative for the remainder of the industries in total in Western Australia.
That may be the case, yes. Mining generally accounts for, is overwhelmingly the biggest contributor to that GOS plus GMI figure.
Yes.
I should note the gross operating surplus plus gross mixed income figure is only a very loose proxy for profitability. It's,
Certainly, yes.
It's certainly, there's no ideal measure of profitability at the state level. So this is a proxy, but not necessarily a completely accurate
Yes.
reflection of profitability. You're right. If you took out mining, it may well, the aggregate figure may be less or a negative.
Yes, yes.
I think this year there was slightly more industries that had a positive increase in GOS plus GMI.
Well, certainly retail trade
Yes.
is one of those which is an area of employment in the award wage area,
Certainly.
although you've got other areas like accommodation and food services which are negative, but yes.
Yes, and that certainly reflects the, I guess, the mixed nature of fortunes in different.
But it may be that
State.
the profitability in the mining industry is, if you like, a leading indicator for profitability in other industries in the future.
Yes, and certainly during the, although it's not suggested that we're necessarily heading back to the mining boom days of the last decade. Certainly the significant growth in the mining industry during that period and the profits that did flow through certainly had an impact on other industries, and once it flowed through to the economy, certainly helped
Yes,
helped other industries.
It's a stark reminder of the role that it plays within this state.
It certainly is. I was quite amazed at how much of the economy is actually made up by the mining industry. Yes, certainly.
Thank you for that.
No problem.
You were about to talk about the equal
yes,
remuneration principle.
the state wage fixing principles, and certainly the equal remuneration principle. So Section 50A 1D of the Industrial Relations Act requires the Commission, when issuing a state wage order each year, to set out a statement of principles to be applied and followed in relation to the exercise of its jurisdiction under the Act to set the wages, salaries, allowances and other remuneration of employees or the prices to be paid in respect of their employment. Section 50A 3A VII of the Industrial Relations Act provides that when making a state wage order, the Commission's to take into consideration the need to provide equal remuneration for men and women for work of equal or comparable value. Following the 2018 state wage case, the Commission initiated application 34 of 2018 on its own motion to develop an equal remuneration principle that could be included in the statement of principles as part of this year's state wage order. After significant consultation between the parties, including with the assistance of the Commission, Unions WA, the Minister, the CCI, all reached agreement on the draft terms of a new proposed equal remuneration principle. A full copy of the draft equal remuneration principle was included in the Minister's primary submission at attachment C. The draft equal remuneration principle is largely based on the equal remuneration principle that's existed in Queensland since 2002. The Queensland equal remuneration principle has operated effectively for many years and is widely seen as an effective model that reflects best practice in gender pay equity. The Minister notes that the draft equal remuneration principle is supported by all of the Section 50 parties participating in this year's state wage case and is also supported by WACOS. On 11th of April 2019, the Minister tabled the final report of the Ministerial review of the State Industrial Relations System and the State Government's proposed reforms in response to the review in the West Australian Parliament. The review was undertaken by Mark Ritter, SC, and the final report makes a total of 85 recommendations for reform of the State Industrial Relations System to ensure it is modern, fair and accessible. In response to the final report, the Minister has indicated that the Government's intention to include a legislative equal remuneration framework in the Industrial Relations Act to assist the Commission in dealing with applications for equal remuneration orders. The proposed legislative reforms will also require the Commission to develop an equal remuneration principle to guide such matters. And the enabling legislative provisions that are proposed will be based on those in the Queensland Industrial Relations Act 2016. The inclusion of the draft equal remuneration principle in this year's Statement of Principles would complement the Government's proposed reforms, which would require an equal remuneration principle to be developed as part of that framework. If the draft equal remuneration principle is included in the Statement of Principles, the wording may require minor revision in due course to ensure it remains consistent with any legislative provisions that are ultimately included in the Industrial Relations Act. However, it's anticipated that any required amendments would be very minor in nature and that wouldn't alter the substance of the principle itself. The Minister contends that the draft principle that's been developed is a practical tool that may assist parties in furthering equal remuneration matters. It's operated successfully in a number of years in another jurisdiction, and the Minister asked that it be included in the Statement of Principles as part of this year's State Wage Case Order. I'm not sure if the...
I have a question for you.
Certainly.
If you have a look at paragraphs 7, 8, 9 and 10, we have in 7, the Commission is to have regard to the history of the award, including any assessments of the work in the past, whether, and some of those considerations are whether there's been any characterisation or labelling of the work as female, whether there's been under-rating or undervaluation of skills of female employees, etc. If you look at point 8, gender discrimination is not required to be shown to establish undervaluation of work, therefore there's no requirement for a male comparator. 9, comparisons within and between occupations and industries are not required in order to establish undervaluation of work on a gender basis, and that such comparisons may be used for guidance in ascertaining appropriate remuneration. The proper basis for comparison is not restricted to similar work. Given that the context of all of those things is that it is equal remuneration for work of equal or comparable value, and the equal appears to be equal with male.
It's equal in
because
terms...
it's all about gender.
Yes. I mean, essentially, the equal is in the sense that equal with other occupations that have not been undervalued on a gender basis.
Gender.
Yes.
Yes.
And it is likely that in practice, invariably some comparisons will usually be made with a male.
And that's the thing that
Yes.
that I think needs to be handled with some subtlety, on the basis that it's said that there's not necessarily a need for a male comparator. And I'm very conscious of the difficulties that have been experienced in the federal jurisdiction by the need for a comparator, a male comparator. But I'm wondering if you are able to give us any indication of the experience in Queensland, if those words are used in the Queensland principle, how they've been applied.
Yes. I may need to take that
You
on
might
notice.
like to get some instructions on that.
Certainly.
Yes.
I know there has been 3 successful equal remuneration cases in the Queensland Industrial Relations Commission using this principle.
Right.
So it has had successful outcomes. What I can do is perhaps drill down into those cases to see how they've dealt with that issue. Essentially, the reference to gender discrimination not being required, Part 8 goes hand in hand with Part 9 in that obviously if you require a male comparator, which has been problematic in the federal jurisdiction, invariably then you're, I guess, restricting the range of comparator groups, and it may be that there's another female comparator group that hasn't been, that has wages that aren't undervalued.
That may be so, yes.
And certainly because traditionally with the male comparator, it's often, you're often comparing very disparate industries, so you might be comparing childcare with, it always seems to come back for whatever reason to the metal trades, and it seems to be the C10 rate, and so it's always comparing some female occupation with somebody bashing metal or soldering or doing something like that, and that may not be the ideal comparator occupation. But I'm happy to
I think that would be helpful.
provide some further
Yes.
information on how the Queensland cases have actually dealt with that issue
Yes, thank
under
you.
the principle.
When do you think you'd be able to do that for us?
Yes, I can certainly take that away and provide something in the next couple of days, if that
Thank you. That would be helpful.
certainly. No problem. If there's no other specific questions on the equal remuneration principle, I was just going to finish off with a brief discussion of apprenticeships and traineeships.
Thank you.
No problem. The Minister's written submission includes detail on apprenticeship and traineeship commencements and numbers in training. The information and analysis regarding training arrangements in Western Australia has been provided by the Department of Training and Workforce Development, and the Minister thanks the Department for providing this information. As outlined in the Minister's submission, apprenticeship and traineeship commencements have declined in recent years, although the Minister is pleased to note that in 2018, almost 400 more people commenced apprenticeships than in the previous year. An updated schedule of registered training packages and industry skill levels was appended to the Minister's primary submission for inclusion in the state wage order. In conclusion, the annual state wage order plays a vital role in maintaining a strong and sustainable safety net for employees in the state industrial relations jurisdiction by protecting the needs of the low paid and maintaining a fair system of wages for Western Australia. The Minister supports the Commission taking a balanced and considered approach to minimum and award wage setting. This includes consideration of all of the social, economic and labour market objectives described in Section 50A3 of the Industrial Relations Act, including the requirement to consider the need to contribute to improved living standards for those West Australians who are reliant on the state minimum wage and state award rates of pay. As outlined, the Minister believes that granting a real wage increase in 2019 to the low paid via $19.20 per week adjustment to minimum and award wages represents a fair quantum that would provide a meaningful increase to minimum and award wage earners, improving their relative economic position in the community and enhancing standards of living. The Minister submits that the effective date of the state wage order and any adjustment to minimum wages should be 1 July 2019, applicable from the first pay period on or after that date. The Minister has no further substantive information for these proceedings, though the Minister reserves the right to respond to matters raised in the presentations of the other parties. If it pleases the Commission and Court session, this concludes the Minister's submission.
Thank you, Mr Andrew. Now, Mr Farrell.
Thank you, Chief Commissioner. Before I begin providing my submissions to the Commission and Court session, I'd like to reiterate that the Chamber's position is that there should be an increase in the minimum wages, and the quantum that we are supporting is 1.4%. And I make that point because my following submissions may indicate to the Commission that we do not support an increase when that is not the case. We do.
I had read them as being supportive of an increase. Thank you.
So in reply to some of the other parties' submissions, Unions WA refer to the following quote by the Reserve Bank Australia Governor Philip Lowe in their submission. And it states, if we're going to deliver average inflation of 2%, we should probably have average wage increases over long periods of time at 3.5%. And then adds, if we can get decent productivity growth. And I note the Chief Commissioner mentioned that earlier in Mr Christmas's evidence. So it's important to note that while Philip Lowe outlines the benefits of lifting wages growth, he makes it clear that wages increase must occur in conjunction with productivity growth. This is consistent with CCI WA's submission that productivity is necessary for wages growth. If wages artificially increase without a corresponding lift in productivity, businesses are likely to respond in a number of ways, including cost absorption. Businesses operating in a highly competitive industry may not be able to pass the cost of a wage increase on the consumer. As a result, their options are to either lower profits or reduce expenditure elsewhere, such as investing in capital. Now, Mr. Christmas made quite extensive note about the increase of business investment expected over the next few years, and I'd like to point out that is trite. That investment will come from those employers in the larger income earning industries and are likely to be more in the federal system rather than unincorporated associations or sole trading employers. In the case of small businesses, cost absorption may also result in reducing working hours available to employees in a number of ways, by owners increasing their working hours, reducing service levels, so fewer staff employed at any one time, or reduced trading hours. Paragraph 2.4 of Unions WA's submission notes that workers who are likely to be paid the lowest rate, which they can be lawfully paid under the state system, are more likely to be in precarious employment arrangements. These are in turn more likely to be in service industry employment, such as retail, accommodation and food services. In paragraph 3.3 of their submission, Unions WA also notes that businesses judged to be more likely to be in the state industrial relations system are those that are unincorporated. These workers are more likely to be impacted by the state minimum wage case. So while these workers are affected by changes in minimum wages, so too are the businesses paying those wages. CCI considers that unincorporated small and medium businesses operating under the state industrial relations system are operating in very competitive conditions under very tight margins. This suggests a limited capacity to pass higher costs onto consumers or reduce expenditure without affecting employment levels within their business.
Sorry, Mr. Farrell, where do
Yes.
I find that, the tight margins bit, in terms of evidence?
In terms of evidence, sir, if you refer to the it's a paragraph 199, sir,
Thank you.
of our initial submissions.
What page is that, sorry, Mr. Farrell?
Paragraph 199. Yeah, actually, I regret, sir, we didn't
That's all
number
right.
the
That's all right.
pages.
I'll handle that, thank you.
So does the chart and 199 go together? I just know, like earlier on, there were footnotes. I was only up to earlier pages in terms of the footnoting, but is there a footnote there that I can go to? It sounded like a submission rather than evidence.
Well, we're referring obviously to that chart, sir, and we say a natural result flowing from that is a limited capacity to pay. They're in tight margins, hence the low increase in profits. We don't suggest in any way, shape or form that the industries are not profitable. We're saying that there's a reduced capacity to pay due to the tight margins and profits that are made.
So you say that's an inference we should draw?
Yes, Chief Commissioner. Noting, of course, there's no guarantee that those profits will continue.
So I asked Mr. Enchikin about the Minister's knowledge about businesses' capacity to pay.
Yes, sir.
And it seems to me, with respect to the Minister, that he hasn't gone to a lot of trouble to find out what the business's capacity to pay actually is.
Yes.
Have you?
Not in a great terms of detail, Commissioner Matthews, to be fair. However, we say that the economic data that we have produced within the initial submissions leads to that inference.
Okay, thank you.
So just to follow on, in terms of the operating competitive conditions under very tight margins, this suggests a limited capacity to pass higher costs onto consumers or reduce expenditure without affecting employment levels within their business. It is important to consider how unincorporated businesses are performing to determine to what extent they can internalise increasing labour costs. Unions WA has correctly highlighted that workers of those businesses are most likely to be impacted by increases to the state minimum wage. Analysis and outline on pages 45 and 46 of our initial submissions indicates that over the 5 years to 2018, adjusted for inflation, total unincorporated profits have increased at just 1.2% in real terms per year on average. Chart 24 on page 46 of our submission indicates that the accommodation and food services sector are operating in particularly difficult conditions, and that's further outlined in the GOS and GMI table provided by the Minister. This sector has experienced negative average annual growth in gross operating profit of minus 1.3% over the 5 years to 2018. Retail has experienced anemic growth of 0.9% over the same period. These figures are national total profit figures, as the ABS does not publish state profit figures. As outlined in page 46 of our initial submission, industries in Western Australia have been experiencing more difficult conditions than eastern jurisdictions. And this indicates that the growth in average unincorporated gross operating profits in Western Australia is likely to be lower than the national 1.2% figure. Low profits point to low margins, which indicate a highly competitive environment in which the ability to pass on costs to consumers is limited. As we've noted in our initial submission, if businesses are unable to pass on cost of a wage increase, they are likely to respond by reducing expenditure, and this includes a reduction in labour costs. A reduction in labour costs could be achieved by reducing hours available to employees, reducing service levels, or reducing trading hours, as I previously identified.
Mr Farrell, I think it's been said by us over a number of years now that the research tends to indicate, and I think it was Professor Barrett gave some evidence some years ago about the particular things that businesses will do to cope with cost increases. But I think overall what we've found on a regular basis is that there is no evidence to support an argument that there is an automatic assumption that there will be a reduction in jobs or employment generally by a wage increase, that a modest or moderate wage increase is unlikely to have any significant effects upon employment. I think that's the finding we've made year after year. Do you have anything that would dissuade us from that?
Well, I have submissions. Whether you're persuaded or not is for you.
I might add to that, Mr. Farrell. I
Yes.
think Dr. Lee's research tended to suggest that was his view, that modest adjustments to the minimum wage tended to have very minimal impacts on levels of employment. The qualification of that, of course, and the rider is always the state of the economic circumstances.
Yes, sir.
But that seemed to be his view, flowing from his research, and I know there's been some comments about that research in Unions WA's submission. Some were critical of his conclusions, but nonetheless, that's what he said as well, cited in your submission, of course.
I guess it comes down to what's a moderate increase in the circumstances of the economic environment and the particular business situation.
And as mentioned before by Senior Commissioner Kenner, that's the $64,000 question that we are here to, or for you to determine. But in essence, I'd like to point to the research by Newmark and Washer that's in paragraph 182 of our initial submissions. And they examined 102 papers on this very, very topic. and concluded that 2/3 of economic studies found that increases in minimum wages have a negative and statistically significant effect on employment, but find different sizes of the effect. In my view, the Commission should not, or sorry, I should say in CCIWA's view, the Commission should not dismiss these results as being suggested and simply assert that increases to the minimum wage increases employment and seek to disregard 2/3 of journal papers, indicating that increases in minimum wages have a negative and statistically significant effect on employment. So to summarise, in answer to your question, Chief Commissioner, that would be the research that we would be pointing to.
Thank you.
But even if we were to take Dr. Lee's and the other points that you're making with Senior Commissioner Kenner, sorry. Is that the research reiterates the importance of the Commission exercising restraint when setting the minimum wage, as placing undue pressure on businesses will lead to adverse outcomes for workers receiving the minimum wage. Furthermore, the argument that increasing minimum wages would provide a direct benefit to businesses, in our view, does not hold. The assertion that all retail businesses, for example, would benefit from an increase in the minimum wage due to higher consuming spending is flawed. CCIWA has not seen any evidence proving that a $1 increase in businesses' labour costs would translate to a $1 increase in revenue for those businesses due to higher consumer spending. Recovering higher labour costs via increased consumer spending would require all customers of a business to experience a wage rise, not just those on the minimum wage. Those who are not on the minimum wage do not experience an increase in purchasing power after the minimum wage is increased. And this means that only a small percentage of increased spending following a minimum wage increase would flow back to businesses that have experienced an increase in labour costs. This would suggest, and an inference can be inferred, a net loss for the business if they were subjected to excessive wage increases. Briefly, I'll turn to youth unemployment. In their submission and reply, Unions WA referred to the following piece of work included in the WACOS submission, and I quote, "Research contained in the WACOS submission demonstrates that low wage growth is a factor that increases the likelihood of young people remaining unemployed for longer periods of time. When the CCIWA argues that minimum wage setting is important to actively facilitate and support employment opportunities for young people and those seeking to gain or add skills and qualifications, it is getting the situation of young workers backwards. We say that Unions WA is misleading in their reference to research outlined in the WACOS submission. WACOS refers to research that finds, and I quote, young people who have experienced poverty in the family home while growing have much poorer employment outcomes than those that experience a greater standing of living. We say there is insufficient evidence to suggest that low wage growth, as Unions WA asserts, will lead to long-term youth unemployment. Youth employees fill a disproportionate number of low-skilled positions for their relative population size and are therefore most severely affected by the introduction or increase of the minimum wage. An extensive study by Newmark and Washer, as cited in our original submissions, surveyed 17 countries, including Australia, and concluded that in general, our results provide evidence that minimum wages tend to reduce employment rates among the youth population. They state that the most significant effects in teen and youth unemployment markets in response to minimum wage increases were experienced in Greece, the Netherlands, and most relevantly, Australia. CCIWA contends that entry-level jobs are a pathway out of unemployment for young people because it provides an avenue to enter the workforce, develop skills and experience, and move on to higher paid work. Making it more difficult and expensive for businesses to hire staff it'll be harder for unskilled young people to enter the workforce. As a consequence, youth unemployment pressures will persist. There is a significant incentive for low-paid workers to upskill and improve their standing in their own income bracket. Key issues facing youth unemployment includes the higher proportion of part-time workers, the frictional unemployment component, as in young people moving in and out of jobs often, and lack of adequate skills.
Mr Farrell, what proportion of people move out of low income or minimum wage employment and onto sort of higher pay rates, as I think you're suggesting, and what proportion stay in that?
With respect,
bracket?
Commissioner Manuel, I was suggesting that there is an incentive for them to move on, to be able to move on to higher employment.
No, I understood your submission. I'm just asking if you can assist the Commission with a sense of how many people do move on and how many people stay.
Might be something you could have a look at and provide us with a submission on.
Certainly we
You
can
don't
do
have
that,
it
but,
now.
but I can answer that question now.
All right, thank
And
you.
my colleague has pointed me to it. And that is that there are over 76% of people on low-paid employment move into higher-paid employment in less than a year. And this is a stepping stone that gets our young people into the workforce and gives them valuable skills they need to build a career and encourages employers to give them a go without having to prove any workforce skills. I'm quoting here, the source is the Department of Jobs and Small Business Analysis using the HILDA, HILDA, survey in December 2018.
Thank you, Mr Farrell.
Do you require any further submissions later on that point? Or would that satisfy your?
No, you've answered my question. Thank you.
Thank you, Commissioner.
Mr Farrell, I don't want to rush you. I'm just wondering if you're going to be much longer or whether we'll break for lunch now and reconvene, or if you're going to be finished in 5 minutes.
I would prefer, if I have a preference, Chief Commissioner, that we break for lunch now.
All
I
right.
don't want to go too long. I can't.
We'll do that then.
Yes.
We'll adjourn now until 2:15. Thank you.
Thank you.
The hearing stands adjourned.